Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's Option Series episode, we're taking covered calls to the next level. Last time we covered how to generate premium income from your stock holdings while managing that capped upside risk. But what happens when your perfect neutral setup suddenly turns into a rocket ship or your shares start tanking? That's where today's mission comes in, rolling calls. This is your tactical escape hatch and reload protocol to stay flexible without getting pinned down. The objective is simple: master when, why, and exactly how to roll your calls so you never get stuck holding a losing position or watching winners get called away too early. Think of rolling a call like repositioning troops during a firefight. You're not surrendering your position. You're pulling back to higher, more defensible ground while collecting fresh intel and supplies. In option terms, rolling means closing your current call option and immediately opening a new one in its place. You buy back the old call to eliminate that obligation, then sell a new call to collect fresh premium. There are three main roll directions, each with a different purpose. Rolling up means moving to a higher strike price, perfect when your stock surges and you want to let winners run further. Rolling out means extending the expiration date into the future, buying you more time when the stock's hugging your strike too closely. And rolling up and out combines both for maximum flexibility. Key point number one, rolling isn't free. When you buy back your original call, you're often paying more than you collected upfront because time decay and stock movement have boosted its value. But the new premium you collect offsets the cost and often leaves you with a net positive. You're trading one obligation for a better one. This keeps your shares working for you instead of getting assigned or stuck. When to roll. Trigger 1. The stock blasts toward or past your strike with momentum. When I trade covered calls, this is actually my preferred scenario. I am looking to get assigned to collect the full premium at the potential rise in stock price. As I buy with the intention of trading, I have no desire to hold on the underlying for an extended period of time. If this trigger is hit, I will just wait for the assignment at the expiration. If by any reason that does not happen, I will of course roll up and out the call. Trigger 2. Early assignment risk. Deep in the money calls, especially before ex-dividend dates, can get exercised early. Dividends are the major reason for early assignment. As you will see in a future episode, that is exactly what happened with my ExxonMobil trade. The difference is, I was expecting early assignment and I was hoping it will happen. The downside in this type of setup is, you will miss on all potential further upside move in the stock and on the dividends. If you have a strong conviction on the stock and it has a lot of space to move higher, by all means, take the hit and roll up the call. Trigger 3. The stock drops hard, but you still like the name long term. Your original call is worthless now for the buyer, but you will collect the full premium. You can also consider, instead of letting it expire, to roll down to a lower strike or out to a further date. This recaptures some premium and resets your break even lower, turning a neutral play into a mild bull recovery bet. Now, let's walk through a case study. No taxes or commissions here. Always factor those in your real trades. You're holding 100 shares of Delta, average purchase price of 65, and you sold the 68 March 27 call for 2.30. That's $230 in credit. 2 weeks in, Delta moved to 69.67. Your March call is now at the money with assignment risk. If you want to keep the shares, it's time to roll. Step 1. Calculate net position. Original credit, $230, and based on the last ask for 68 call, it would cost you minus $85 to buy back your call. Your gross on close, profit of $145. Step 2. Select new call. April 10th, 70 strike, bids at 1.97. Let's calculate the net roll. 145 plus 197 equals 342 in credit overall. You've extended upside to strike 70 at a net gain. Let's now look at scenarios at expiration. Stock at 66. Expires worthless. You keep your shares plus 342 net premium. As combined premium exceeds your initial premium, rolling made sense. Stock at 70. Assigned at 70 for 500 stock gain plus 342 in net options premiums. This is my ideal outcome scenario, as I on covered calls always look for an assignment to collect the premium and cash in on the stock move. Stock moves to 90, same capped profit as in 70 scenario, but you could have rolled again midway. Rolling compounds your edge over static holds. In this case, you would most likely have to close the option position with a net loss, but you would participate in the upward stock move. This case study shows that rolling up makes sense if you believe the stock has more upside potential. If you are indifferent about the underlying shares and without strong conviction on the stock, it is oftentimes better to let assignment happen than to roll the calls. Rolling shines because it weaponizes time decay twice. You collect premium upfront, then again on the roll while giving your thesis more runway. It's pure data capture in action, perfect for volatile dividend names where stocks swing but pay you to wait. Institutions love this. It's why covered call ETFs consistently outperform in sideways to up markets. But danger zones exist. Rolling costs time and commissions. Don't do it weekly on choppy stocks or you'll bleed edges. Avoid roll marathons where you keep kicking losing calls down the road hoping for recovery. That's just delaying pain. And never roll naked calls. Keep it covered with shares you control. If IV spikes massively, like pre-earnings, rolling might cost more than it's worth. It might be better just to close outright. Check net credit after roll. If it's negative and deep, consider closing the covered call entirely and redeploying capital. The real risk, opportunity cost. Rolling ties capital longer than planned, so have a maximum rolls per position rule like twice or 3 times max per quarter. Let's go now through some common rolling mistakes. Rolling purely to avoid assignment without a thesis. If you hate selling at 150, don't sell the 140 call initially. Pick out of the money strikes you're generally happy with. Rolling from indecision breeds sloppy trades. Ignoring net math. Beginners eyeball higher strikes without calculating buyback minus new credit. If your roll costs $3 net, that's that capital. Walk away unless conviction is ironclad. Rolling into IV crush. Post earnings, premiums tank. Don't roll then or you'll collect pennies for big risks. Wait for IV rebound. No exit calendar. Set alerts for 21 days to expiry and 5% stock moves. Blind rolling on emotion destroys discipline. Only roll when it objectively improves your position. Patience turns this into a superpower. When to avoid rolling entirely, skip rolling on high conviction moonshots. Take profits outright instead of capping further. Low IV environments mean thin premiums, not worth the friction. And if shares tank 15% below purchase with no rebound signs, close the call, cut losses, move on. Rolling's a tactical reload, not a life support system. Rolling calls is your reload maneuver. Close the old obligation, open a better one, and keep premium flowing whether stock grinds sideways, gap down, or gap up. Trigger on momentum towards your strike price, early assignment threats, or jobs you believe can rebound from. Calculate net credits religiously. Hunt 5 to 10% higher strikes or time extensions and always protect your downside. On our next episode, it is time for the monthly wrap-up to see how the accounts performed in March. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.